Kenya's Vision 2030, the country's development blueprint, is on course. Just this week, the country's finance minister confirmed that the country had received $240 million in the first tranche of the $600 million syndicated loan to be used for supporting infrastructure projects in the 2011-2012 fiscal budget.
Syndicated loan, we financed negotiations, we signed the agreement. It's now for us to call upon them to send it to us. As I said, we wanted it in two tranches, one this year and the other one the following year. Now that the shilling now is under pressure, we are now going to ask for half of that money to come so that it can support the shilling. Yeah, but really we wanted for budget support, and so far we are quite comfortable. We are living within our own means. We are living within our own means, but to reduce the pressure on the shilling, I think we are now going to call on the banks now to send the money to us.
The loan, which comes with an interest rate of 4.75% above the LIBOR rate, is expected to boost the central bank's foreign exchange reserves and reduce pressure on local interest rates. Lately, there have been jitters in the market caused by the recent slide in the shilling when it hit a traded low of 86.85 to the US dollar last week on Wednesday, its weakest level since January 17, 2012.
It is true that last week was bad for the Kenya shilling. It depreciated, went as high as 87. But the good news is that it's coming down. But basically, in May, we expected it to be under pressure. In fact, if you look at all the other years, every time in May it is under pressure because of three things. One, this is the time that companies with overseas shareholders pay their dividend. And you can call all of them: Safaricom, East African Breweries, Barclays Bank, Standard Bank, yeah, Baburi Cement. All those companies pay their dividends this year because their financial year is in December.
Despite this development, the country's current account deficit widened to 13.6% of GDP in the first quarter of the year, largely due to increase in import values of fuel.
Kenya's always had a negative balance of trade. If you, in contradistinction to that of, let's say, Tanzania and Uganda. So we are big consumers of imported goods. Kenyans love imported goods. They love imported cars. We don't, we actually do have a car industry in Kenya, but it's almost insignificant. It's much cheaper to buy a Japanese second-hand car, or even a German or a British or whatever it is, one of those second-hand cars, than buying a new car which has been made in Kenya, a new vehicle which has been made in Kenya. So the first thing I think we have to remember is that we have this incredible balance of trade deficit. That means that a lot of the goods that are coming into Kenya, being used for manufacturing purposes or whatever, are coming through the port of Mombasa. Our imports through the port of Mombasa are much greater than our exports out of the port of Mombasa.
The other one, but this is again is normal, is our current account deficit. It is increasing and is worrying. That I'll tell you is worrying to us. It means that we are importing more than we are exporting, and which means that we are also importing some completely unnecessary items. Again, I've put up a team at Treasury. We want to identify which these imports are, yeah, and whether there's something that we can do about it. Because in my view, the only item that really only two items really in my view we should be importing. One, fuel. Good news, we have some fuel in Turkana, but we haven't seen a single cent yet from revenue. And maybe capital, machinery.
Kenya's debt level is also significantly lower than many rich countries including Italy, Greece, US and Japan, whose debt levels are over 100% of GDP. However, this has not stopped economists raising concerns on the country's public debt, which currently stands at 1.51 trillion shillings.
The point, of course, is that we spend far too much money on governance in Kenya. Far too high a proportion of our GDP is spent just simply on running government. And, you know, an enormous amount of this, an increasing amount of this, is actually spent paying our national debt. The government is borrowing more every year. And how effective is this expenditure? Very ineffective to my mind. We've got to really look at slimming down government, having better focus of what exactly government should do.
And with economic growth projected to slow to between 3.5 and 4.5% this year, attention now shifts to Parliament, where the Finance Minister is going to present the 2012-2013 budget next week. Reporting for Eye on Kenya, I'm Ken Karuri.